Hello, Steve Lentz here with Discover Options. Welcome to this edition of the Market Reports for Friday, March 3rd, getting ready for the open on Monday, March 6th. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Folks, we have two reports for you today. The S&P 500 Condor Butterfly Timing Report that will assist those of you trading delta neutral market neutral premium collection strategies to better time the entry of those approaches. And then also we have the S&P 500 directional likelihood report for those of you more statistically oriented that want just some good numbers based upon some very interesting data. So we have that for you as well. Before we get going, I want to encourage you to subscribe by clicking on the button. And also we have a book for those of you brand new to us, Simple Steps to Options Trading Success. This is a free ebook we will get you if you click the link. Give us your data. We will get that to you right away. All right, let's take a look at the current market condition. We'll look at the reports, and then for those of you new, we'll dive into the methodology as well as the trading idea at the very end, okay? All right, the market condition ending up on Friday, and we express in terms of three things: price action, trend, and then the overbought, oversold levels. From a price action perspective, Thursday was an inside day, Friday was a downswing day. Okay, now that's a very unique price action. Doesn't happen that often, and then so that's for that component, price action. Now the close, we're above the 50-day simple moving average, and in terms of the stochastic, the overbought oversold indicator, we are between 70 and 100. We're in overbought territory, but we are trending downward underneath the 3-day simple moving average of that 15.3 stochastic. So all this combines for a very, well, pretty much a rare market condition. It's happened about 44 times in the past, inclusive of consecutive, consecutive times. And so just keep that in mind moving forward. The population of this market condition isn't as robust as, say, others that have occurred maybe 200 times since Jan of 2000 instead of 44. Okay, so let's go to the first report. That's the current market condition. The Condor Butterfly Timing Report. Looking at that market condition that I just expressed, here's the narrative we have with coinciding with these numbers. So since Jan of 2000, there have been almost 4,300 daily closes of the SPX. Okay, of those, 64.9% have been favorable bars for selling option premium, where the actual 21 bar movement was less than the SIBO skew adjusted implied movement. Okay, so basically about 65% of the bars going back to Jan of 2000 have been favorable for doing condors and butters. All right, now that's in hindsight, of course. That's in hindsight, and we define that by comparing the 21 bar actual movement to the SIBO skew adjusted implied movement. Now also during that time, our current market condition has occurred roughly 43 times. 43 times. Now, of those 43 occurrences, 72.1% of those bars have been similarly favorable for option premium selling. Okay, now that means that we have a 7.2 edge, okay, over and above the baseline of 64.9. So statistically then, it's more likely than normal that Friday's bar will end up having been favorable for market neutral option premium selling. Okay, so that's the Condor Butterfly Timing Report. We're operating right now in an environment of favorableness relative to just what the baseline level is, all right? So we're going to get into the methodology behind that in just a little bit, but for those of you veterans, just wanted to throw this out there for you to see and then move on. But for those of you brand new to the methodology going on, stick around, you'll want to see this. Okay, let's go to the market likelihood report for the statistics of the market. What we do is we cast three volatility bands up, above the close, and three below. These are set 5, 10, and 15 days out. One standard deviation, 5, 10, and 15 days above the close. 1 standard deviation 5, 10, and 15 days below the close. And the question is how often will those bands get hit from a close moving forward 5, 10, or 15 days? Okay, the benchmark you'll see at the top, the historical distribution. Okay, the upper 5, 10, and 15 day bands get hit, you could see roughly between 23 and 30% of the time. Now the lower bands get struck roughly 29% to 32% of the time. That's out of almost 4,300 occurrences. That's the baseline. Now when we go to our market condition that's occurred 44 times, of those 44 times, price then, just exclusively looking at those 44 times occurrences, okay, the market ends up hitting the upper band. You can see that 18.2, upper 10-day band 25, 15.9, and then we look at the difference between these numbers and the baseline that I just expressed. And you'll see that the difference is we have a lot of red numbers here, meaning that their price is not hitting those bands as often as normal. We see a lot of red numbers here. We see and conclude that there is a higher probability that the market will be less volatile than normal. It's not a guarantee, because you could see price does go up and hit these bands or down and hit the bands. It's just that after our market condition, it statistically has not hit those bands as often as normal up here. Okay, so in this case, what we're seeing is a picture of lower market volatility. And if that's at all predictive from the past, looking at the future, the odds are that the market will be less volatile than normal. Okie dokie, let's take a look at the, now if we recast those bands, instead of a 20-day statistical volatility, we expand them out to use the VIX. The baseline bands are not getting hit as often, as you can see, but still we have a lot of red numbers here indicating quite a bit of lower market volatility. Keep in mind too, the occurrences just aren't what we would prefer, which is 100 or more. 44 is a low number, a low population. But I want to report it anyway because we do have a fairly rare market condition right now. All right, let's get to the methodology now. Thank you very much, those of you veterans. If you want to stick around, this is the same material that you've been seeing every week. For those of you new, take a look at this. You're going to want to see how it is we come up with these numbers. Let's take a look at the Condor Butterfly Timing Report. Why would you want to look at this? Then we'll look at the methodology. We'll look at the current condition and the edge level. For those of you doing condors and butters, you might wait for the market to channel around, shop around a bit. If you're, it's not always the case though that you can eyeball this. In our case, we run this through our algorithms here back in December of 15. Had you run this through, look at the market. It was chopping around a bit. You might have done a Condor butter thinking it was a good time to get into that. However, if you run it through our algorithm the way we do it, okay, there ended up being a negative 4.2% edge. That meant that at the time, there was a higher than usual likelihood that the market was going to be more volatile than what was implied by the option prices. And now in that case, that ended up being predictive, and the market did get quite a bit more violent afterwards. All right, so here's the question on the table. Is our current market condition that I just expressed, okay, a good market condition for selling option premium through range trading, butters and condors? That's the question that this report seeks to answer. All right, now how do we do that? How do we answer that question? We first observe how much the market actually moves from a close. We call that actual volatility. Then we observe what the market move is predicted by the option prices. That's the implied volatility. What market move is being predicted at the time by the option prices. We then, in hindsight, compare the two, and we label each bar favorable or unfavorable for having sold premium. Let's take an example of this. Let's take a look at actual market volatility. Okay, the actual move. What we do is we look at the actual move, the actual 21-day move. You could take any close, go forward 21 bars, and ask yourself, how far did the market move from there? In this case, it moved farther to the downside than the upside, and so when we do the math, we discover that it moved 50 points, which ended up being 2.4% to the downside. Now, at the time, here's the big question: what market move was being implied by the option prices at the time? And when we take a look at the VIX, we discover that the VIX was implying a 4.4% move. The market only moved 2.4. So that bar ended up being favorable for selling premium. Okay? We, in that case, would then paint the bar blue. All the bars that are similarly favorable like that receive a blue coloring like this, favorable for selling option premium through range trading. The red ones are the bars where the market ended up moving more than what was being implied. Okay, so we can carve up the bars either blue or red, very simple. Now the most recent 21 bars we're not going to know because we haven't had enough time go by that we can look back in hindsight. But we can go back all the way to Jan of 2000 in our case, label each bar either blue or red. Now, here's what we're going to do. We're going to look at historically what percentage of the bars are favorable, going all the way back to Jan of 2000, what percentage were favorable. Then we look at the bars that match our current market condition. And we ask ourselves what percentage of those were favorable for selling premium. Okay, if there's a big difference, that could represent an edge. All right, so let's take a look, first of all, historically. When we go back in time, and discover, since Jan of 2000, 64.9% of the bars going back ended up having been favorable for selling premium neutrally, Condors and Butters. 34.1% were unfavorable, meaning that the actual move was more than implied. Okay, now let's take a look at those bars that match our current market condition. On this whole screen, going back several months, ours is what happened Friday is the only day. You'd have to go back a ways to start seeing some more incidences. Okay, but of those 44 incidences of this exact same condition developing, an inside bar followed by a downswing bar, overbought territory coming down on the stochastic, yet we're above the 50-day, unique condition, right? Okay, of those 44 incidences, 72.1% ended up being favorable for selling premium, Condors and Butters. 72.1, not too bad. Okay, that meant that we have an edge of 7.2%, 72.1 minus 64.9. That means there's a higher than usual likelihood that the market will be less volatile than what is implied by the option prices. There's an edge here. Okay, now you might still encounter 27.9% chance. You could still encounter rough waters for selling premium neutrally, Condors and Butters, but at least the odds are more in your favor now than if it was the opposite. Okay, where it was, say, at 60% instead of 72. So there's a bit of an edge right now as we speak. That's it for that report. Before we go on to the market likelihood report, folks, we have a great curriculum here at Discover Options. We can take you from wherever you are, beginner, intermediate, take you up to the level of an advanced option trader capable of even managing other people's money. We have money managers on our team that can help you get to where you want to go. So give us a call. We'd love to work with you and take you wherever it is, wherever your goals will take you, okay? All right, let's take a look at the market likelihood report. I showed you these numbers previous. Here's the question on the table. Since Jan of 2000, how often has this same market condition occurred? And we'll already answer that. It's 44. Okay. And of those 44 times, what did the market do in terms of direction and volatility? What did the market do in terms, if we go back into those 44 times, we discover that the market always went up or always went down, that would give us some confidence to take a more directional, perspective now, wouldn't it? All right, so that's our study. Now, how do we do this? First, okay, our likelihood analysis methodology. We first understand the historical distribution of price. Then we're going to understand the price distribution after our little market condition developed. Okay, if there's a big difference between the two, well, we're gonna take a look at that. There could be a good edge there, bullish, bearish, or even volatility related. Okay, so let's first examine what distribution of price is. Instead of just typing in a system, go long here, have a trailing stop, and all that, I just want to examine whether there's even a price bias to our given pattern. Okay, a price bias. I'm not looking for a trading system. I just want to see the distribution of price is generally different under a certain condition over and above another. So here's what price distribution is. We do this by establishing 3 sets of volatility bands. These are upper and lower set bands, 5, 10, and 15 days from the close. A standard deviation band, 5, 10, and 15 days out, using a 20-day historical volatility figure, and it's normally distributed, of course. Just an example here. Here's an example of 10-day bands. We have the close. We have a certain volatility level that calculated from the last 20 days. We determined that the 10-day one standard deviation level is up here. The 1-day standard deviation level to the downside is down here. And what we're going to do is simply, for this close, record whether price hit the upper band or the lower band or hit neither band. Now let's go see what happened here in this case. In this case, it clearly hit the upper band. So for that particular close, we record that it hit the upper band. That's what we put for that one close. Now, here we have another close. We have the upper 10-day band here, the lower 10-day band here, and we're going to examine if price hit the upper or the lower or didn't hit either. So let's go take a look. And you'll see that it tried to hit the lower band but failed to by just a little bit. So for that particular close, we record that it hit neither band. Now, what we do to determine historical distribution is that for each close, we record whether price struck the upper or the lower 5, 10, and 15-day bands, and then we calculate those statistics and record these as a percentage. So here, through March 3rd, from Jan of 2000 through March 3rd, the historical distribution is price struck the upper, this is in the SPX, price struck the upper 5-day band 29.5% of the time, the upper 10-day band 23.3% of the time, the upper 15-day band 23.3%. You can see these other statistics for the lower bands, 29 to 32% roughly. See that? So that is the baseline distribution of price. Now we're going to then put that to the side, and now we're going to go look at the distribution after our specific condition developed. So we go and we take a look, and I'm just showing you that over the course of several years, we haven't had, but in this particular case, going back to 2013, 1, 2, 3, 4, 5, 6. There have been only 10 incidences, inclusive of Fridays, of our same market condition having developed. Now what we're going to do now to determine distribution, we're going to look at the distribution after the close for those 44. Now for some of those, price went above Friday's high. We want to know what the distribution was in those cases where it penetrated Friday's high. What about Friday's low? If price on Monday goes down below Friday's low, I think it'd be helpful to know what the distribution of price was in those instances as well. So here it is just after the close. Of the 44 occurrences in the past, you could see price struck the bands far less often than the baseline numbers. I mean, just take, the baseline is 29.5. Hit it only 18.2% on the upper 5. Okay, the upper 10-day band actually is about almost 1.5% more, but the others, price struck the bands far less often than the baseline by quite a bit in some cases. Okay, especially on the upside there. Look at that. Okay. So there you have it, just a picture of lower market volatility out of these 44 incidences. Most of the time it failed to hit the bands and we experienced lower market volatility. Okay, now let's take a look at what happened in those 19 occurrences where price went above Friday's high. In this case, Friday's high. Again, lower levels of price, price failed to hit the bands quite often. It hit those bands less often in pretty much all the cases. In fact, it never did strike the upper 15-day band. Look at that, 0%. 0%. Okay, now, what I like to do, let's take a look if price goes below the low of Friday. Here you can see 4 out of the 6 failed to, it failed to hit the band as often as it does baseline. So more red numbers here. Again, a picture of lower market volatility. Market likelihood report, this is where we use the skew adjusted VIX to determine the width of the bands. The VIX is generally higher than a 20-day statistical volatility number, so it's the bands are set farther away, hence they're getting struck less often, as you can see. And even then we have a lot of red numbers here, price striking the bands far less often among these 44 occurrences. All right, so that's it for the likelihood report. I'm showing you the volatility numbers here. The 20-day statistical volatility is at 7.4. The upside VIX at 9. The downside VIX is calculated at 12.9. We're going to take that 12.9 number and take a look at a hedged bull put spread just to see for grins what it would look like using a 12.9. We're going to go out to April at 47 days. 12.9, that establishes our 1 standard deviation level down at 2270. That would be our stop on this. We take the credit here, use it to purchase a hedge, an at-the-money bear put spread. And when you run the analysis out, you have a real good looking picture here. Real good looking picture where if price goes down, that hedge kicks in, and you could make 17% on your money. If price goes up, you're still making 6% on your money. So if it goes down, you can make almost 3 times what it is you're trying to make on the upside. And we're in this so long as price does not go below that short there. Okay, well, that short is at 2270. All right, let's take a look at the price chart. In the profit region, it looks excellent. All price has to do is wobble around just a little bit, and you're going to make money so long as it doesn't collapse completely, go down to 2270. This strategy can make some money. And if it does go down, wobble around and go down, that's where you can make a lot more money than if it goes up. Folks, thanks for joining us. I'm Steve Lentz with Discover Options. Have a great week trading. We'll talk to you next week. Bye-bye.